So here's a good question for the group this morning. What's the most you can lose? So good morning once again, options traders. And this is a question I always like to ask everybody, especially for our new traders, because if you talk to most people, they will tell you that the most you can lose is the amount that you paid for an option. And it really gets down to a matter of perspective. Are you trying to just guard against the initial principle? Or is there something else we should be looking at? So let's go take a closer look. What is the most you could lose on an options position? So before we do that, as always, please be sure to click like and subscribe. It is definitely helping to promote the channel and is greatly appreciated. So first off, with long options, the conventional thinking is that the most you can lose is the amount that you paid. However, from a risk management perspective, it says the most you can lose is the current price. And this is why we do in the markets what's called mark to market. We are going to mark your position every single evening, or at least your broker's platform will, at the closing price. And the reason that's done is to not only show you the value of the position and the value of the account, but it also helps you to understand what your current risk is, because that is always the most you could lose. It doesn't matter what you paid for the option. Once you pay for it, that's a sunk cost. Your decisions are all going to rely on current market conditions. So for example, let's take a look at a profit and loss diagram that we look at in just about all of the videos. This is a $100 call, purchase for 5. There's our bend right at the $100 price. There's the most we can lose is 5. So remember that the black line is the expiration graph. This only applies right at expiration. But this red line is the current curve. So we read it the same way as the black line, but this might apply, let's say, with 30 days to expiration. So most of the time when we look at something in terms of profits and losses, part of the line, take a look at the black or the red, will sit below 0. And that's because the reading off of this graph is telling you what actually lands in your pocket or is taken away. How much profit do you have, or how much of a loss do you have? It is not showing the current value of the option. That's being subtracted out. So for example, if you paid $5 for this option and the stock goes to 105 at expiration, so if we're talking about at expiration, we would be reading off of the black line. Notice that we just break even. That doesn't mean that the option's worth 0 at this point. The option's worth 5, but because you paid 5 and you could close it for 5, your profit or your loss is 0. So a profit and loss diagram can kind of hide the amount that you have at risk because it's not showing the total value of the option unless you look at this price and then add back in your purchase price. And so sometimes we look at what's called a payoff diagram. Now it's exactly the same thing, we're just not going to subtract out the option's price. So the $100 call right now is showing a payoff at 0. And what that means is that at expiration, if the stock is 100, right, they're lined up at 100, you would get 0 payoff. Doesn't mean you'd have a 0 loss. It means that the option itself would be worth 0 and you would lose whatever you paid for it. So based on the previous graph, it would be minus 5. But do you see what's happening here? We're not accounting for the cost of the option. We're just looking for the current value. So now it's a little easier to see that if the stock is 105 at expiration, we look right up there and there it is. The option would be worth 5. If the stock is 110 at expiration, we can see it would be worth 10. If we want to know what it would be worth today, we look at the red line. So yes, with the stock at 105 at expiration, it would be worth 5. But today, let's say with 30 days to expiration, looks like it's worth about $8. And so that's what that price is right there. What if the stock gets up here to 110? See, now we're going to look up here on the red line. That's worth about $11. And so this is a much easier way to see what the option is worth. And this is really the amount that you have at risk. So yes, you might have paid $5 for this option, but if it's worth 11 right now, is it really fair to say that the most you can lose is 5? From a risk management perspective, you should realize that, hey, I could lose $11. I could sell this now and put $11 in my pocket. Doesn't matter that you paid 5. This is the amount that you have at risk. So this is really important to get better at options trading. Yes, again, on one hand, you could say that in terms of the principal that you've put up at risk, the most you can lose is what you paid, but it's not a very good way to approach risk management. So this is where we get into the hedges, rolls, and morphs. So we've talked about rolling in previous videos. Let's say that maybe as the stock price moves up, we might sell our 100 call and buy the 105, and we move from the black line to the blue. See, now I've raised this floor. The most I could lose originally was 5. Now it's only 1. This would be assuming that we rolled for a $4 credit. Now the trade-off is I have a 105 strike. I used to have the 100 strike, which all things being equal would be more beneficial. And we can see that the blue line is shifted a little bit to the right of the black line, in this case by $1. And so that's the trade-off. We have to increase our break-even point ever so slightly, but the reason we do the rolls is to lift this maximum loss up off of the floor. So if the stock continues higher, we might switch or roll from the 105 to the 110. We might go here. Now I've got my entire curve above 0. Now I can get all of my initial principal back plus a guaranteed profit, but I still have the ability to make unlimited gains. I haven't let go of these potential deltas out here. We could also potentially do morphs. Maybe we get up to an area where we think we're going to hit some resistance, and we maybe sell off a lower strike call and leg into a bear spread. I might be able to do this. And so now I can lock in the gains, but also switch directions. I've switched from bullish to bearish. But to make better decisions, the thing that you have to see is that your true risk is not what you paid for the option. It's the current market price. And if you keep that in mind, it will give you a lot more appreciation for these hedges, rolls, and morphs. So you can see, yeah, you might have paid $2 for an option, but if it's worth $20 now, you might think, well, why should I hedge it or roll it or do anything, morph it, because I can only lose 2. And now hopefully this shows that that's not true. This is why you need to guard your gains. So these hedges, rolls, and morphs are not just locking in gains from your principal and giving you a guaranteed gain with the ability to maybe make more, but they're also reducing the amount that you actually have at risk once you consider the current market price. So just always remember that it's always about mark to market. The amount paid is the initial principal at risk. Yes, that's true, and that's the basic definition that you usually see as the amount that you can lose. But what you have to realize is that as market conditions change, risks change. First and foremost, as that stock price moves, whether up or down, as volatility changes, these things all change the value of the options, and it therefore changes your risks. So always remember that the current market price is the most you can lose. That's the better way to look at it in terms of risk management. And it's the rolling and morphing that reduces the risks and locks in your gains. And that's why they are so important. So always keep an eye on that current market price. Understand what the total value of your position is right now, because that's truly the amount that you have at risk. And once you do that, you'll have a much better appreciation for the rolls and the morphs. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.